This is unfolding right now. As I capture this video in real time, we're witnessing a coordinated offensive on the silver market. Check the tape, check the volume. 5 million ounces of paper silver just slammed into the bid in under 3 minutes. This isn't everyday retail selling. This isn't traders locking in gains. This is a calculated algorithmic flood engineered to shatter the $74 support level ahead of Wednesday's Fed minutes. I'm watching the level 2 data, and I can see the spoofing orders. I can see the layering. I can see the banks attempting to paint the chart red to frighten you out of your position. Why? Because they're terrified of what tomorrow brings. This is an urgent update. I hadn't intended to record today, but you need to witness this manipulation as it happens. This is education, not financial guidance. Confirm the data independently. Links are in the description. Drop a comment if you're watching this sell-off unfold live. Let's examine the 1-minute chart right here. 8:42 a.m. Eastern, volume spike, 2,000 contracts unloaded. 8:43 a.m. Eastern, another 3,500 contracts. 8:44 a.m. Eastern, 4,000 contracts. That's nearly 5 million ounces of silver offloaded in 3 minutes. Do you grasp how much physical silver 5 million ounces represents? That's 155 metric tons. That's roughly 6% of COMEX's entire registered inventory. Do you believe a physical holder simply woke up this morning and chose to liquidate 6% of the exchange's stockpile in 180 seconds? Of course not. This is paper. This is naked shorting. This is an algorithm designed to inundate the market with sell orders to trip stop losses below $74. They're attempting to engineer a cascade event. They want to hammer the price down to $71, activate the stops, and then scoop up the contracts at the low. It's a raid, straightforward and transparent. And they're executing it right now because liquidity remains thin following the holiday weekend. They know the order book is sparse. They know they can shift the price $2 with comparatively modest capital. It's manipulation on the cheap. Examine the level 2 order book. Notice those enormous sell walls at $74.50 and $74, blocks of 500 contracts parked on the offer. That's 2.5 million ounces of supply that materialized from thin air. Now observe what occurs when the price approaches them. They vanish. The price ticks upward and the sell wall evaporates. Then it resurfaces 10 cents higher. This is spoofing. It's unlawful. JP Morgan paid $920 million for executing precisely this tactic. They post a bogus sell order to repel buyers, to fabricate the appearance of overwhelming supply, to manufacture the illusion of a collapse. But they have zero intention of actually filling those contracts. If the price reaches them, they pull them. They're hurting the market, steering the price downward like a shepherd drives sheep. And the regulators? Nowhere in sight. The CFTC is dormant while the banks operate the casino. But here's the encouraging part. The spoofing isn't producing the results it once did. Watch the bid side. Someone is accumulating. Someone is absorbing the deluge. The price dipped to $74.15 and snapped back. This signals a major buyer on the opposite side. One content to take everything the banks are offloading. Who is this buyer with the resources to soak up 5 million ounces in minutes? It's not retail traders. It could be a sovereign wealth fund. It could be a Chinese state enterprise. Or it could be a rival bank. This feeds the interbank conflict theory. We tend to assume all banks operate as a unified cartel. But what if they're waging war against each other? What if Bank A is short and frantic to crash the price while Bank B has pivoted long and is fortifying the floor? We're watching a collision of giants, a battle of algorithms. Volume is surging, yet the price is barely budging. That's called churn. It indicates a massive change of ownership is underway. Vulnerable positions, Bank A's paper shorts, are transferring to resilient hands, Bank B's accumulation operation. When the seller depletes its ammunition, the price will rocket. Why are they dumping today? Why Tuesday? Because tomorrow is Wednesday, Fed minutes day. The banks have intelligence. They possess early data. Perhaps the minutes lean dovish. Perhaps the Fed is alarmed by the jobs revision. If the Fed telegraphs vulnerability tomorrow, the dollar plunges. If the dollar plunges, silver surges. The shorts recognize this. They have a 24-hour window to exit. They're attempting to bludgeon the price down today so they can close their short positions cheaply before the announcement drops tomorrow. This sell-off isn't bearish. It's panicked bullishness. It's the shorts screaming for the exit. If they were confident the price would naturally decline, they wouldn't need to dump 5 million ounces in 3 minutes. They'd sell gradually. They'd sell discreetly. Aggressive, conspicuous dumping is a hallmark of desperation. They're forcing a move because the market's organic direction is upward. The physical disconnect. Live. While this paper chart is printing red candles, let's check what's happening in the real world. I'm pulling up Shanghai right now. Shanghai silver benchmark, up 0.5%. Hold on. New York is down 2%, but Shanghai is rising. The premium just expanded. The divergence is intensifying in real time. And while the banks flood New York with paper, the Chinese are bidding up physical in Shanghai. This confirms the New York move is artificial. It's isolated. It's disconnected from worldwide reality. If this reflected a genuine supply surplus, Shanghai would be falling too. It isn't. The arbitrage window is widening dramatically. Every cent the banks push COMEX lower, they make it more lucrative for traders to drain the vaults and route metal to China. They're undermining their own position to protect their quarterly bonuses. I just received word from a bullion dealer contact. Premiums on Eagles just increased by $1. Why? Because retail buyers are spotting this dip and purchasing. The paper price falls, so the spot price drops. But dealers understand they can't replenish inventory at these fabricated prices. So they raise the premium to safeguard their margins. Spot down, premium up. The total cost for physical silver hasn't changed. It's holding steady. This is the floor. The physical market is refusing to participate in the paper sell-off. If you attempt to buy silver right now based on this chart, you'll be let down. The apparent discount is a mirage. Let's pull back to the 4-hour chart. We're forming a hammer candle, a long lower wick with the body closing near the top. This indicates sellers drove it down, but buyers pushed it right back up. If this 4-hour candle completes as a hammer, it's a bullish reversal signal. It validates that $74 represents solid support. It validates the bear trap. The banks attempted to flush it out. They couldn't, and now the technical setup is priming for a rebound. Watch where this candle closes. If we recapture $75, the dump has failed. And a failed dump triggers a violent rally because the shorts who sold at the bottom are now cornered. They must buy back at higher levels to close their positions. Browse the comments section. Browse Twitter X. Fear, frustration, hopelessness. Silver is finished. It's heading to $50. I'm getting out. This is precisely the reaction they're engineering. They're harvesting your emotions. Sentiment functions as a contrarian signal. When retail participants are at peak fear, the bottom is established. The banks are running the same sentiment algorithms. They see the fear gauge spiking. They know the crowd is in a frenzy. That's their cue to buy. Don't be part of the herd. Be the hunter, not the hunted. When you observe a 5 million ounce dump, don't ask, why is silver collapsing? Ask, who's acquiring 5 million ounces? Follow the capital flow, not the mood. If you're actively engaged right now, what's your move? Don't sell into the dump. Never sell on a panic candle. You'll get the worst execution. You'll cement the loss. Watch for the reclaim. Monitor volume. You want to see volume diminishing on downward moves and rising on upward moves. That reveals sellers are spent and buyers are taking charge. Check the miners. Are mining equities dropping as steeply as the metal? If silver is down 2%, but miners are only off 0.5%, that's a divergence. Miners frequently lead. If they hold firm, the metal will follow. Set price alerts. Don't fixate on the screen and let emotions take over. Set an alert at $76. Step away. Let the market do its work. The desperation is plain to see. This real-time dump is a revelation. It validates everything we've been discussing. The banks remain active. They're still manipulating, but they're faltering. They hurled 5 million ounces at the market and barely cracked support. The physical barrier is intact. The Wednesday catalyst is approaching. This is the ultimate shakeout. The final effort to strip your holdings before the next advance. I'm holding. I'm buying the physical dip. I'm tuning out the paper noise. Observe what they're doing. Document it. Remember it. Because when silver reaches $100, you'll look back at this moment and recognize it as the inflection point. The desperation of the seller is the opening for the buyer. Confirm the data. Trust your instincts.